So example one is AMP, which is American Financials Incorporated. And as you see here, I've drawn in the opening range. This is the opening range here. And I've drawn in my demarcation line. Now I'm ready to trade. Okay. So entry at $58.77. My stop loss was at $58.30. My exit at $59.32. And my profit was 55 cents. Okay, so entry at $58.77. Right there. So we're waiting for a close of the 5-minute bar above the opening range. If the bar comes up, it doesn't close above and pulls back down into the opening range, then we do not trade. We do not open that trade. We definitely have to wait for that bar to close. Even if it does look like it's going to close, we wait until the 5 minutes is over before opening our trade on the next bar. So what we're looking for on the next bar, we're looking for a break of that 5-minute bar. Essentially is the best way to manage the trade. Waiting for a break of the bar and entering on that next bar. Okay, so we're looking at this bar here was 58.77, and that was our entry. Our stop loss was at 58.30. So we placed our stop loss below the 20 period moving average. And this is the line that we trail our stop loss up. So the stop loss is really just an emergency cutoff point. We want to be exiting our trades when we want to exit our trades. We don't want them to be stopped out. But if the trade suddenly goes against you and you're managing another trade, then the stop loss is there to prevent you from having any major losses. If anything happens in the market, there's some piece of news, and all of a sudden the trade reverses, you've got your stop loss there to save you. If you didn't have your stop loss, and for example this trade reversed, and you were distracted by something else, the trade could be down here in minutes, in absolute seconds, and you don't want that to happen. Just a few of those. If you're in 4 or 5 trades at the same time, a few of those could be very, very hazardous to your capital. So the first thing we do after entering our trade, once we've entered our trade, we go straight away. We don't do anything else besides put in our stop loss. And so we're looking for that stop loss below the 20 period moving average. So we exited this trade at $59.32, and that means we stayed in the trade as it pulled back to the 10 moving average, bounced off the 10 moving average, came back down, bounced off the 10 moving average again, and came up, and then we closed out as it broke and closed below the 10 period moving average. Okay. Depending on the futures, if the futures are strong and still heading upwards or still rallying, I would actually hold on and wait for a close of the 20 period moving average, because if the price doesn't bounce off the 10 moving average, it is more than possible it might bounce off the 20 period moving average. But it just depends on what the futures are doing. If the futures are pulling back quite dramatically, then it's probably a good idea to exit. There's also a number of other indicators that I will look at to signal an exit on the trade. And that's my exit over there. Exit at 59.32. The results of that trade was a profit of 55 cents. Trading 100 shares in the US would be a profit of $55 less commissions. If you were spread betting in the UK and you're trading £1 per point, your profit would have been £55.